In this video, you're gonna learn about the 5 best bank ETFs in Canada. Hey, what's going on? It's Chris here from Wealth Awesome. Canadian banks have a reputation for being robust and generous with their dividend yield. The big 5 banks, along with the National Bank, showed amazing resilience during the last 2008 recession. And they are displaying swift recovery after the pandemic-driven market crash. I believe that Canadian banks deserve a place in most investment portfolios. If you agree and want to add these somewhat stable and high reward stocks in your portfolio, but don't want to handle the securities individually, this video is for you. I hope this list of the 5 best Canadian bank ETFs will help you find the right fit for your portfolio. So before we get into it, make sure you stick around until after the list is finished, and I'll go over if I think it's even worth it to buy Canadian bank ETFs and who should be buying it. So one of the first Canadian bank ETFs that you may want to look into is the BMO Covered Call ETF. The ETF is primarily comprised of 7 different holdings. One of them is another ETF, which is the BMO Equal Weight Banks Index, and it's called a ZEB. This makes up more than 1/4 of the total ETF's asset allocation. The rest is distributed among the big 6 almost equally. National Bank of Canada makes up 13.25% of the weight, which is the highest, and the Bank of Nova Scotia is the smallest holding at 10.14%. The ETF takes the cake in terms of its dividend yield. Dividends are typically the primary reason people are interested in Canadian banks, and this ETF offers the most generous yield out of all the other ones in the list. It has a higher than typical fee and MER, thanks mostly to its covered call strategy, which allows its investors to earn call option premiums. The fund managers have to put in the extra work of underwriting call option premiums and analyzing volatility. So this covered call ETF is rebalanced twice a year. While its dividends are generous, the fund doesn't offer much in the way of capital growth. Even if we consider the valuation before the crash, the fund increased its share price by just 20% in the past 5 years prior to this year. So if your goal is just dividends from Canadian banks, this might be the right ETF for you. My second pick is the BMO Equal Weight Banks Index ETF. A bit ironically, my second choice for the second best Canadian bank ETF is the main holding of the first ETF in the list. So this is the one I was talking about earlier, which is the BMO Equal Weight Banks Index. And true to its name, it just contains all 6 banks plus a very small portion of cash holdings. The weightage is not so equally distributed though. The largest holding is the National Bank of Canada with 18.5% of the weight, and the lightest holding is Bank of Nova Scotia at 14.17% of the holdings. So the first fund not only owns the ETF, but the rest of the holdings also follow the same pattern. In terms of the distribution of holdings, this ETF can be considered the parent ETF as it's almost 2 years older than the first one. So the almost equal weightage and the fact that all 6 banks grew their market value slowly but steadily in the past 5 years has resulted in this ETF that's not just about dividends but also capital growth. Its price grew over 40% in the past 5 years prior to the crash. And thanks to that, even in its currently low valuation, which is 13% down from the pre-pandemic highest value, its 5-year CAGR, which is dividend adjusted, is 9.11%, which is pretty good. That means if you consider the combined returns of dividends and capital growth, the stock grew its investors' capital by 9% each year in the past 5 years. That's a very decent rate of return. So my third pick is CI First Asset Can Bank Income Class ETF. So this is the first ETF on the list that's not from one of the big 5 banks. The ETF was created by CI First Asset in August 2010. A few things that are different about this fund is that unlike the other funds which pay monthly dividends, this pays quarterly dividends. Secondly, it also sells call options which are capped at 25% of the holdings inside the portfolio. The fund claims to focus on capital appreciation, but its 5-year records don't augment that claim too much. Its dividends are strong enough, and I account for them here. Its yearly returns based on the 5 years dividend adjusted CAGR is almost 7.6%. The holdings in this fund is more equally distributed than others in the list, but the lead holding is still the National Bank of Canada. The availability of options and a chance to earn premiums on these call options makes its fees and MER a bit higher than usual. Its price is having trouble recovering to its pre-pandemic values, so keep an eye out for that in 2021. The fourth one on this list is iShares Equal Weight Bank and Lifeco ETF. This Canadian Bank ETF was created by BlackRock's iShares, which is the largest ETF issuer in the world. But apart from its globally known creator and manager, this ETF is different from all others in the list for one main reason. And it's that this fund isn't created solely of just banks. The bulk of it, almost 58%, is made up of the banks. The rest is distributed among insurance institutions, which makes up the rest, most of it, at 38%, and diversified financial companies at 3%. 5 of the big 6 banks make up its top 6 holdings, and all of it's equally weighted. The fund is also geared more towards growth than simply dividends. Though its yield is decent enough, it shouldn't be the only reason to consider adding this fund to your portfolio if you're looking for both dividend and capital growth. Then it might be a good pick for you. Since it's not comprised solely of Canadian banks, it does appear to be a bit more volatile than the others, but this is also positive since it can grow even when the banks become a bit stagnant. If you consider its 5-year history, its annual growth rate, dividend adjusted, comes out to 7.85%. The last one on the list, number 5, is the RBC Canadian Bank Yield Index ETF. Closing out the list is the newest ETF of the bunch. This Canadian Bank ETF was created by RBC in October of 2017. And while it does just consist of just the big 6 banks, it doesn't have an equal weightage, unlike all the other ones listed. The composition is a bit different here. So their top holding is CIBC at 25.1%, Scotiabank at 23.8%, BMO at 17.3%, TD at 17%, and the lowest weightings is actually its own stock at RBC has 8% and National Bank of Canada is 8%. So I found that pretty interesting. Its lowest holdings is its own bank stock. So the portfolio leans very heavily on 2 of the banks. The largest bank and the fastest growing bank represents the least weightage in the fund. This configuration is essentially tracing the sole active Canadian Bank Yield Index. And while this does result in a decent enough yield, it doesn't show a lot of promise when it comes to capital growth. It's a pretty new fund and not as time tested as the other funds on this list, so we can't write it off completely regarding capital growth. One of the good things about this fund, though, is its relatively low fees. They're almost half of what seems to be the norm for these funds. All right, so here's an important topic. Are Canadian bank ETFs worth it? So it's a bit of a tricky topic. So for one, some banking ETFs are a bit risky. Not all the banks are equally stable, and some are too exposed to elements that can potentially weaken their earnings, putting their dividends in danger. These elements include too much exposure to the housing market, foreign businesses, and investments in politically unstable countries. In an equally weighted bank ETF, 1 or 2 poorly performing banks can bring down the performance and distribution of the ETF as a whole. Secondly, these ETFs are risky. As you've seen, some of the best and most commonly chosen Canadian bank ETFs essentially just have a portfolio of only 6 banks because there's not a lot of banks in Canada. These ETFs are not a broad market index following ETFs with hundreds or thousands of stock holdings. They're just 6 different banks. So if you're only interested in the dividends and not actually trading the banks or delving into options, paying for a sizable MER doesn't always seem that justified. A 0.71% MER means that if you invested $10,000 in the ETF, you will end up paying $71 a year just in fees. You can save a lot of it by just buying the securities directly. You can also tweak the weightage of the banks in your portfolio to suit your risk tolerance, growth, and dividend prospects. But based on some of the performance and management, such as covered call strategies, some of the ETFs might be worth the extra cost. In the end, it depends upon the ETF itself and your own preference. If you don't want to manage and tweak your portfolio yourself, and simply want to bank on the security of the Canadian banks, most Canadian bank ETFs might be worth it for you. However, if you don't mind buying and selling the bank stocks individually, you'll have to keep up with the bank stock performance and prospects and decide if that's a better route for you. So you really have to decide, is what I'm trying to say, between bank ETFs or individual banks. I personally think bank stocks, they're fairly easy to buy, but I know people really like ETFs, so it's a really good option as well. So how to buy Canadian bank ETFs as a Canadian. I'm gonna give you two options. I usually just give one, which is Questrade. For the first option is Questrade. I personally use it to trade most of my stocks. It has a desktop and a mobile trading platform. Plus all Canadian ETF purchases are free, but be aware that selling ETFs will cost a small fee. With this offer, you can get a $50 in free stock trades in the description below. I also want to provide another option, which is Wealthsimple Trade. So if you don't mind buying and selling ETFs on your mobile device, there really isn't a better way than to use Wealthsimple Trade, because all Canadian stock and ETFs, buys and sells, are commission free on the platform. And again, check the link in the description. There's a $10 sign up bonus when you sign up. So choosing the best Canadian bank ETF goes beyond just its dividend yield. The equally weighted funds carry almost equal risk and offer similar growth potential. So if you prioritize growth over dividends though, you might be better off managing your own portfolio of stocks or choosing an ETF with an unbalanced weight distribution. Alright, since you made it this far, make sure you like and subscribe to the channel so you don't miss any new content every week. Also, be sure to check out the blog, wealthawesome.com. It's one of Canada's leading personal finance resources. It goes into this topic in way more detail, and it's got way more topics for Canadians to take a look at. And as always, thanks for listening.